Hey guys, and welcome to my YouTube channel. In today's video, I'll show you how you can set up the screener for quick screening of stocks, which will be sort of a very helpful activity you can do whenever you get any stocks for recommendations. Now, this topic I have already covered in previous videos and also have shared the formulas with you guys before, but still many people are finding it difficult to do this from ground zero or from scratch, and this video would be helpful for them. Those of you who have already set up their screener based on the formulas that I have shared, they can easily skip this video because I'll basically be covering the same things. With that said, let's get started with it. So I've just taken a screenshot of how the setup looks like, and I've basically deleted all these ratios that I have created from so that I can easily explain you how you can do it right from scratch or right from ground zero. So this is the screen that we'll basically try to recreate. Now, whenever you log in to the screener for the first time, this is the setup that you will basically be looking at if you select for any particular stocks, and one by one we'll basically try to add each of this ratio. Also, every time I'll be referring to this picture because we want to recreate this same setup. So the first ratio that we'll try to set up is OC by EBITDA, which is operating cash by EBITDA. Now we'll first go to edit ratio. These ratios which are directly not available from the screener setup. Hence we'll basically go to create new ratio. And here we'll basically give it a name, operating cash by EBITDA, and the short name will be OC from EBITDA. This is the name that you will basically see on your screener setup. There will be no sort of unit for this. So the numerator, if you see, is the operating cash, and the ratios that we will try to cover is mostly be on a 5 year at max. If we don't have the data for like 5 years, we'll try to cover it for the recent times. So operating cash we do have for 5 years. So operating cash for 5 years is basically a sum value that is available, and the new denominator is the EBITDA value. So let's say what we have in EBITDA. If you search for EBITDA, so we don't have the direct value of EBITDA. Let's say search for EBIT. So the direct value available is EBIT. Direct value available is EBIT, and hence we basically will focus only on EBIT and not the EBITDA, which includes the depreciation and appreciation also. That will basically part will neglect. Now in EBIT also we have like an average number. So we basically what we have is average EBIT of last 5 annual reports, but the numerator is sort of sum. Hence we basically need to take the average of it by dividing it by 5, and so our numerator is also an average number, and our denominator would also be an average number, which is the average EBIT over 5 years. Now, since EBITDA is not available, basically we are trying to get a ratio as near as possible. If some of the numbers are not available directly in screener, we'll basically stick to whatever is next possible available. Now, in description, you can write this is basically operating cash from EBITDA, and then you can basically show the preview. Now this ratio has to lie between 70% to 120%. It basically shows you a variation in your cash from operations to profit from operations. I'll also show you that once we basically save this ratio and go back to our login screen. Now I'll basically also have this login screen side by side. So here it will be added to your screen now, OC from EBITDA. I'll So this ratio would be added to your screener setup. Now, what this ratio essentially means is that if you go to cash flow and if you see the cash flow from operating activities, if you try to expand it, it basically shows you that the cash from operating activity and the denominator is basically profit from operations. So in a way, we are basically trying to say that most of your cash from operating activity should come from the profit from operations. Hence, if it is 1, it is very good, and we are basically allowing it a 20% variation, that it can go from 80% to 120%. But above that, we shouldn't see a major variation in this number, because that would mean that a major source of cash from operating activities, not the profits from operations, which is sort of a risky atmosphere to operate in. So hence, we basically are saying that we can allow a 30% variation bracket or 20% variation bracket, that by that bracket we will be lenient on those stocks. But if it goes a very high value like 150%, 160% showing variations in cash, then we will basically with red treat it as a red flag. So we have this first ratio now set up. Now we'll move on to the second ratio. So the second ratio is the cash flow from operating activities divided by profit after tax. Now this is almost the same as this first ratio, but it basically tells us that the profit after everything. The first ratio tells us that earnings before income tax and all other things. But after profit, that whatever numbers you are showing in profit and loss statements, is that matching with your cash flow from operating activities? Now this number is also very important. Let's first set it up. Again, this number won't be directly available in screener, hence we need to basically create a new ratio. Now again, we'll go to create new ratio. Here we'll write operating cash from profit, and here we'll write CFO by PAT. There won't be any unit. Again, in numerator we have operating cash flow 5 years, which is a sum, and in denominator we want profit from we want basically net profit. So let's see, net profit is available for 5 years. So here we don't see net profit is available for 5 years. Uh, Hence we'll basically take earnings. Earnings, average earning 5 years. Now average earning 5 years, basically if you read about it, average profit after tax during last 5 annual reports, this is the number that we want. But the denominator again is an average number, and numerator is an sum. Hence we'll basically divide it by 5 and divide the whole thing. So we get our number now. In description you can write basically profit on paper converted to cash, and we'll basically save it. Now this number has to be greater than one for a good benchmark is basically one. And if you see large caps, Hindustan Unilever is greater than one, Reliance Industries, and every basically good company will have this ratio greater than one. Again, if you save this ratio and see, if you refresh this, you'll have it added. So we have added two of these ratios, which are very important. Now let's move on to the third ratio, which is the contingent ratio, which is basically means the contingent liability of any company. Again, contingent liabilities is not directly available. We'll have to create a ratio for it. So same procedure, create a ratio. Here we'll write contingent liabilities. Here we'll write contingent ratio. And the formula for that is contingent liabilities. And in numerator, we shall have net worth. So here again, if you read contingent liabilities as per the contingent liabilities, again here this will basically a fraud check uh, on contingent liabilities. Now again, if you check the previews of it, ratio name itself used in formula. Okay, contingent liability. Now after you could see the for prominent large caps, we'll see this number has to be less than zero point 0.1, which is sort of a benchmark for this particular ratio. But again, this has to be compared with industry leader. In case of like auto industry, this number will be high for all the stocks, and hence it has to be compared to like Maruti Suzuki and other leaders in that particular sector. So let's give this ratio. and we'll have again search for our stock Asian Paints. You can see contingent ratio added, which is again 0.01. So benchmark number for this basically is zero point 0.1, and this is the ratio that we check for an accounting fraud investigations. If there is any accounting fraud, this number will be very high. Now let's move on to the next ratio, which is the cash theft check. Again, this ratio is not available, hence we need to basically create it again. So let's create it. Here we'll write capital work in progress, and here we'll write cash theft check. So formula for this is capital work in progress preceding year, and divided by gross block preceding year. So we basically take a division of this, and this is basically again a accounting fraud check. So cash theft check is generally called, and this is where the company basically do a like a shows a very high capital work in progress, but that never gets converted to any cash or other things. So this is one of the cash theft checks to identify frauds, to identify accounting frauds. So again, if you check the preview, this also number has to be less than zero point 0.1 or has to be compared with the industry standard. So many large cap ratios, you'll see it to be less than zero point 0.1. So again, having created, let's check, let's basically check if it is added in our stock. So yeah, cash theft check did get added in our stock. You can basically choose the name as per what you want. Currently is basically showing capital work in progress, but you can change it according to you. Now the next is basically FCF by sales, which basically means that with the growing sales that your company is showing, your free cash flow numbers should also be growing. Basically, if it is only sales are growing and you're not generating any cash from the business, it's totally useless and the stock price won't rise. Hence this ratio is very important. Let's create this ratio again. It's not available directly, so you'll have to create it. Let's create it, edit ratio. You'll go to create new ratio. Again, if you name it free cash flow to sales, here we'll have FCF to sales, and for formula we can directly use the free cash flow. It's directly available in the screener, but we won't basically use the free cash flow. We'll basically choose cash from uh, operating cash operating cash flow 5 years. We'll add the investing cash flow to this, investing cash flow for 5 years. Now, what is the difference between free cash flow? Free cash flow, basically the number is an addition of operating cash flow, investing cash flow, and the financial cash flow. But we basically won't be considering the financial. Don't want basically to consider the financial cash flow. Hence, we're basically taking only those two top numbers. We'll basically add this, and in numerator we will basically have the sales number. Now, sales again, if you see, sales growth is there, but the sales raw numbers are not there over here. Let's check if revenue numbers are there. Basically, whatever is there, the best possible number we should be taking. Since this number is not available for 5 years, we'll basically take for the last year itself. Since the sales number are not available basically for 5 years, since we'll basically take last year's. So let's take operating cash for the last year. I'll have to delete this entire thing now. Operating cash flow last year plus investing cash last year, and we divide them. So both are sum, and sales is also a last year number. Hence, we'll basically divide them and so since this number is not available for last 5 years, we are basically sticking it to last year itself. And this is the sort of manipulations that we'll do time and time again because the way whatever screener is allowing us to use, we are basically maximizing that sales. We'll basically save it and let's see the preview. Again, let's save the number. Now moving on to the next ratio, which is the I by E ratio, which is to understand how much of your earnings you are investing back into the company. It's again a very useful ratio. So let's create it. We'll basically name investment on earning. We'll name it I by E. We'll have the formula investing cash flow divided by cash flow from operations. Cash operations, operating cash operating cash flow 3 years, so we'll basically change it to 5 years. Correct. And this number will be negative to basically money is going out of the company, hence this number will be negative. If you want to make it positive, you can just add a minus sign over here, but it's better to keep it negative only. So it basically description where you can write investment on earnings. Now you can see the preview, can save the ratio. Let's move on to the next sort of ratio. Now the next ratio is the Altman Z-score, which is directly available, and hence we don't need to basically create it. We can just go to the company's site. Let's check Asian Paints. Ratio is directly available in Screener. You just have to search it over here. So Altman Z-score is directly available, and you can see it's added directly. The next sort of ratio is working capital days, which is also available, I think, directly. So let's check if working capital days is there. So yeah, working capital days is there. You can add it directly. Debt to equity, you can add directly. I think debt to equity is also there. Debt to equity, you can add directly. Pledge percentage is also directly available, so you can directly add pledge percentage. Interest coverage ratio is also directly available, so interest coverage ratio you can add. Equity dilution, equity change or equity dilution means that whatever your shares were outstanding 10 years back are the same as of today. It basically useful to understand if the company keeps on diluting the equity. Now why it is important, because if the stock price has to go up and up, in case of like MRF, if we consider, the stock price has risen so much because they have never diluted their equity. So if having this ratio one, it means that you can expect the company to produce, to grow and grow and not basically dilute their equity for manipulations from the operators. So this ratio is not directly available, hence we need to basically create it again. So let's create it. Here we'll write equity change. Here we'll write dilution, equity dilution. Here the numerator will be shares, number of shares, equity shares now, and the denominator will be number of equity shares 10 years back. Basically take a ratio of n, and here we can write understand equity dilution. Saved. Now if you go to the website, now if you go to this setup, now our setup is sort of ready, and you can see all the important ratios are added over here. Now I'll also quickly explain why these ratios are important. First ratio we have understood to understand the cash from operations and the cash from operating activities, to understand the variation between them. This ratio has to be greater than 1 to understand if the profit on paper is converted to cash. Contingent liability. Contingent ratio again has to be less than zero point 0.1, it is an accounting fraud check. Capital work in progress is again a cash theft check to understand accounting frauds. FCF by sales is to understand with the growing sales whether the company is producing free cash flow or not. This ratio has to be over 5 years, but I couldn't find for 5 years, hence I've created for the last year. But you can also see if it is available for 5 years sales number, then you can create it for 5 years also. I buy is to understand where the company is investing their earnings, whether a large portion of investments is invested back into the company. Now, here we understand that 33% is invested back into the company, but again, we need to basically study the cash flow to understand where the capital allocation exactly is going. Altman Z score is again a very good check. If this ratio is above 2, which is a good sign. If these ratios are sometime below 2, it is basically indication whether the company will go bankrupt or not, hence which is directly available in screeners. Working capital days again have to be compared with the industry leader or what industry standard wise. It basically tells us that how much time does it takes for a company to receive the capital work to convert basically the capital work in progress to a cash. So generally Asian Paints takes around 46 days and hence has to be compared with an industry leader. How much are the industry leaders taking time to convert their capital work in progress to cash? Debt to equity is a very standard which is directly available in the screener. Pledge percentage again directly available. Very important indicators to understand whether the companies have any pledged shares or not. Interest coverage ratios is an indicator to understand whether the company is paying their interest on the debt that it has borrowed in a timely manner. This is basically to understand whether the credit rating of the company won't fall in future. Having these ratios will be basically be greater than 8. Having this ratio close to 8, 10 or 11 also means that in future there is a possibility that the company might default on its payment on the loan that it has borrowed. So having this ratio very high is basically useful. Equity change is equity dilution, helps us to understand whether the company keeps on diluting the equity, and that's why it's a very important ratio. So this setup, is very takes almost hardly 20 minutes to set this up, but it's very important to understand, the growth of the company, the fraud status of the company, if the company is into any frauds or not, and it hardly takes like 1 minute, to quickly glance through these numbers and check whether the stocks can be rejected for an investment purpose or not. So I hope you like the content. It's hardly like very few minutes takes to set this up, and to review this hardly takes any minutes. So I would advise every one of you to have this setup ready, so that you can utilize it as much as possible and safeguard your investments as much as possible. Thanks for watching this video. If you do have any questions, please write in the comment sections. Please share this setup or the content with as much as people possible, so that they also take their investment decision wisely. And if you haven't subscribed to channel, please do that. It will encourage me to put on more and more such important and knowledgeable videos. Thanks, and please give your reactions by liking or disliking the video. Thanks for watching the video. Take care.